It's Thursday, the 31st of August. The euro falls, Europe bonds are bid. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Minutes ago into the end of your cash equity trading session here in Europe. I'm Danny Berger in for Guy Johnson. Alex Steele is in New York. Now, a quick look at your markets. I'm just going to start with the one that's not doing too much. Get it out of the way. Stocks Europe 600. That's barely changed. It had been up. It had been down. Here's where we land. It's the macro forces that are dominating us and a very volume late week that perhaps isn't giving us a direction on equity markets. The euro is falling. We did flirt with 109. We can't hold there. We backed off down by about 0.6%. German two-year yield is also down 10 basis points. That's rounded up, call it 11 basis points. We're just below 3%. This has been a big rally, I should say, Alex. It's not just Germany, the German front end that's seeing this. It's also the UK, too. Now, it seems to be mostly based off of European data for the Eurozone, not the UK, but it's kind of having this effect as the global bond market, basically everything on the front end rallying throughout Europe.
Yeah, and that euro dollar is super interesting, too, that we're not lower based on, say, what Isabel Schnabel talked about. We'll get to that in a moment. So S&P up 0.3%, nothing really to write home about. We had personal spending coming in stronger, income a little lighter. You might be having core inflation coming in just bang in line. So it was kind of a steady as she goes data. Some really fun stories, though, within the equity market. Dollar General getting crushed, down 16%. Their guidance, not good. They cut their net sales and earnings guidance for 2024 for the second straight quarter, getting very punished for it. It's an inventory issue. It's a theft issue. You name it, they have it. And AMC, this is just fun. So, yes, we still maybe think of it as a meme stock, but it's up over 5%. Taylor Swift is going to put her tour in films. Starting in a few weeks. Is it a few weeks? It's October. In October, which may be a few weeks. It's a great way to get people back in the movie theater, right? If the blockbuster didn't do it and Barbie is doing it, but then eventually you're going to go to Taylor Swift, I don't know. As Danny said in the last hour, maybe you just need to make more stuff for women. And the Bloomberg Dollar Index, I did want to highlight that because it's up 0.2%, but part of that's also going to be the yen. Yen seems to struggle as we get to the end of each month. It's a pattern that's happened quite a bit since February, and we're seeing that happen again today. And just something to keep your eye on, Danny.
Yeah, I was just kind of like cheering here in silence. Well, not in silence. I said, yeah, and agreed. We can make more movies for women. Alex, I want to go through what the inflation data has looked like, and I'm going to tee it up for you as to why the market didn't trade how you'd expect it to, given this data. So now we now have all of the regional CPIs in hand for Europe. If you look across the board, save for Spain, we're in that 5 to 6 to higher than 6% range. That is not a comfortable place to be. That is somewhere that you'd expect that the ECB still needs to hike. Even for Spain, we had the confirmation of a quickening of the inflation rate. But we didn't get a reaction to that. Instead, we're looking at bond yields falling. In Germany, I just showed them down by 11 basis points. And you have the euro falling, too. Again, we're backing off of pricing that we're going to get a hike next month. We were split 50-50. Now we have such a low probability. And, Alex, it seems like it might have to do with some of that ECB speak.
Right, so maybe positioning, maybe low volume, but there was also this. So earlier, ECB Executive Board member Isabel Schnabel, who's usually very much a hawk, gave the opening remarks at a conference organized by the Fed and the ECB in Frankfurt. Now, her comments, in the prepared comments, she said, recent developments point to growth prospects being weaker than foreseen in the baseline scenario. We cannot predict where the peak rate is going to be, or for how long rates will have to be at restrictive levels. So, Danny, it felt like that was the moment in the market where we started to pare back some of the expectations for another hike.
Yeah, because if the most hawkish member is flagging the growth worry siren, balloon, I don't know, what do you flag? Anyway, if you have Isabel Schnabel worried about growth, perhaps the ECB can't do any more. And that brings us to our question of the day. Have central banks done enough? Can the ECB afford to stop at this point? Joining us now to help answer that is Bloomberg ECB reporter Jana Randau and Sofia Orta y Costa from our Markets Today team. Sofia, let me take this question to you. Has the ECB done enough?
I mean, I think potentially can't afford to do more right now? I think that's the question, because it's so focused on the worsening economic outlook. And we did see hard data in Germany, in France, really kind of fall short of expectations. And also those PMIs, I mean, they were terrible, Danny. Really pointing to a weakening economy here. That to me suggests that while the ECB still has work to do, it might just afford to wait for the next meeting. So it might not be a September hike, but there's still so much work to be done on the inflation front. I do think that the job for the ECB has become harder.
Yeah, Yana, when I saw the inflation numbers, I was like, uh-oh, they're hiking. Like, this is bad. We're seeing inflation that eventually going to reaccelerate. And then I saw the market, and then I saw Schnabel's comments, and I was like, oh no, this is a very different story. How would you answer that question? Have central banks done enough?
I don't think they have, and they are concerned about the economic outlook, but they are also concerned about stubborn inflation, and Isabel Schnabel made a case in stressing that. I would look at the problem with a slightly different focus. I would say inflation is too high. Central bankers are aware of it. What they need to figure out, and here is where the challenge is whether that slowdown in the economy we're seeing, whether that will have an impact on inflation. And there, the thoughts diverge. So there are policymakers who say, yes, what we're seeing is a cyclical slowdown. Demand is weakening before long. That will bring down inflation pressures. And those people are confident. Those are the doves. They are confident that there is room for a pause. But there are also people on the other side of the spectrum that say, well, maybe the inflation pressures we're seeing are also structural in nature, and that means inflation will not come down. The labor market is the best example here. It is very, very strong in Europe, not much to be seen there by way of reacting to the slowdown. So if that is truly the case, inflation is not coming down, and they say, well, that is a risk for inflation expectations, and you want to err on the side of anchoring and keeping them anchored. Because that is ultimately, yes.
Because if it is a structural issue when it comes to inflation, are rate hikes enough? Is that traditional mechanism the way to get inflation back down?
That's the only tool central banks have. Central banks have exactly one tool to fight inflation, and that is interest rates. If you're dealing with a structural problem, then you will hear calls on politicians getting louder, and we are seeing that to some extent. Get your house in order, create the conditions for a pickup in potential growth. So that is going to happen. But as for central banks, they have a mandate. It's 2% inflation. They have one tool to achieve that. And end of story. If you play by the book.
So if that's the case, and if we're at a structurally higher inflation, Sophia, I'm just wondering, what does that wind up doing to returns? Like, where can you possibly then find solid returns?
The market is really trying to answer that question, and also trying to price in what happens after central banks are done, or after their job is after its job done on inflation. I think that's a really difficult thing to do, because you don't know. I mean, we're talking about Table Mountains. We're talking about what the picture will look like after central banks reach that peak rate, and all the market is focusing on is when interest rates will be cut. So, I mean, let's kind of agree on what the picture will look like before trying to figure out where you'll get those returns. Because returns, if central banks are going to start cutting rates next year, and that's what the market is pricing for the Fed, then your returns are going to be incredibly different starting from the back end of next year. So I do think that the market needs to kind of stop obsessing, perhaps, over what happens next, and maybe kind of just look at the real economy. When was the last time that the market was focusing on earnings growth and actually what is happening to companies, rather than the macro picture and all the kind of shifts and turns in policy making?
Pay attention to something other than macro.
What?
Imagine a world. Sophia, because we have you, I want to apply this question of the day in another way. Have central banks done enough? Has the PBOC done enough? We learned that they were going to be lowering mortgage rates for first and second time home buyers. It excited at least the currency markets.
Yes.
Does that go far enough to the consumption problem, or is there still more work to be done?
This was a big one. So it's not just the mortgage rates. They also reduced the down payment down to 20%. Which, Danny, in some of the bigger cities, it's 50%. So this is a huge shift. And the idea and the market is basically expecting this to be reflationary. China has a very different problem to the rest of the world because it's in a kind of a very difficult deflation, structural deflation problem, and consumers aren't spending despite everything that the PBOC has done. I think the PBOC still needs to do more. Again, to Jana's point, there isn't much it can do other than just cut borrowing costs. And when you don't have demand for credit, you don't have demand for that essentially cheaper money, then what else can you do? And what the central bank is doing is fixing the supply side of the equation, injecting liquidity, so freeing up that extra cash from households, from consumers, and crucially from banks as well, and injecting it into the real economy.
Right, and maybe it's just going to take a second. Like, it's not, we're going to see it tomorrow, so maybe it just needs to filter through a little bit. Wonderful setup. Thanks so much, both of you, Jana Rendau and Sofia Orte Costa. Thank you so much. So coming up, more insight into the question of the day. Have central banks done enough? Or should we just all go away and take a look at some actual cash flow and earnings? All right, Willem Sells, HSBC Private Bank Global Chief Investment Officer, joins us next. This is Bloomberg.
The truth is, Alex, we're debating between no more hikes or 25 basis points more. It's unlikely that they do anything beyond 25 basis points more. I don't see the Fed cutting 125 basis points, which is discounted into the market, into equity pricing right now.
That was Catherine Rooney-Vera of StoneX Financial speaking to us in the past hour. And look, that debate was kind of one we were having with the ECB. Earlier in the week, we had even odds of hikes in September versus not hiking. We got hot inflation data, yet we pretty much completely backed off of bets that we would get a hike in September. That brings us to our question of the day. Have central banks done enough? We're a little bit worried about growth, maybe a lot of worried about growth here in Europe, but the markets are pricing that the ECB could be done, at least for now. Let's bring in William Sells, HSBC Private Bank Global Chief Investment Officer. William, can the ECB throw in the towel at this moment, like markets seem to be pricing? Have they done enough?
It's a bit confusing what is happening today in the market. I would say that the central bank, the ECB, needs to hike. We do think they will actually do it in September, so we're actually a bit more hawkish than the market, who thinks they will delay it and do it at the following meeting. They indeed, the inflation figures have been slightly above, where markets were expecting them to be. So also keeping in mind that the ECB really has that one single mandate focused on inflation, cares about growth, but is not, part of its firm, target. What you do have, though, from a longer-term perspective, is that, the weakness of the U.S. dollar is probably behind us, because we are looking more at growth differentials, and they are obviously, the U.S. is looking better than the Eurozone, so that makes play.
Willem, help me understand why the euro isn't weaker today.
So, it's a confusing situation. I think that, I'm not a day trader. I think that, from a longer term perspective, from the next couple of weeks, the next couple of months, I do think that, if anything, there's a little bit of upward pressure, on the US dollar relative to the euro. I do think that the market shifts as we are getting closer to the end of the rate hikes. We're probably done in the US. We have one to go in the Eurozone, one to go in the UK market. I think that the market shifts its focus from those rate hikes or from the rate differentials to the growth picture. And that growth picture, is a little bit more resilient in the US than in Europe. So therefore, at the margin, maybe even a little bit of strength of the dollar.
To get to that place where we care less about yield differentials and more about growth, do we need to see the end of the Fed rate hiking cycle? Is that the kind of timing and sentiment shift?
people may need to have that final rate hike. You know, when we talk to our clients as well to get into the bond market, you know, quite often they also want to see the final rate hike. You know, you're never sure, obviously, because you may have a pause and then a further hike. You know, obviously markets start to price that in earlier. And so for bonds, for example, we are saying, you know, this is a real, especially after the spike in treasury yields, a very good entry point. So you don't really want to wait until the last rate hike.
I mean, this may be a little bit of an unfair question, but when we have the data this week, right, and then we have the reaction in the market, and we have our question of the day, how much stock should I be putting in all of this, considering that it's the end of the month, it's August, and volumes are light? Like, what's going to take to get a true read on market reaction here?
So I think basically what is, you know, if you are in a situation where we're very, very close to the end of the rate hikes, or you have seen them, as we think, in the US already, that plateau of interest rates is a good environment for risk assets, for bonds and for stocks. You then obviously want to pick those areas with the most resilience, which again, you know, points you to the US relative to the Eurozone, where you have weaker growth plus a stickier inflation problem, and therefore indeed the central banks potentially have to go for longer. So what you also want to do in that low growth environment, obviously, is looking for those companies that can make the money. Now, people have been looking at tech. I think that's not the only place you can look, especially in the US. You have a lot of other sectors that are doing well. And so you've seen, for example, over the last few months and weeks, the financials catching up, the industrials catching up, you know, because that market rally is broadening out.
Where are you still seeing big dislocations between fundamentals and valuations? Where's some of that classic active strategy you see useful?
So I would think that, you know, where you, one of the points that is important to realize, especially, you know, as what you're seeing today as well with sometimes that confusing data, is the market is going to shift its view very quickly from one regime to the other. So we think about this as, you know, high growth, or weaker growth, and high inflation or more comfortable inflation. So you have 4 quadrants, 4 regimes, and even within a day, but certainly within a week, the market can shift its view. So therefore, what you need to do is, on top of all of those, you know, long only strategies that we have, also look at hedge funds to play that, you know, volatility, especially as implied volatility is also very low. So you can go long short, or you can do volatility strategies to manage that.
All right, William Sells of HSBC Private Bank, thank you so very much. Just some breaking news for you. This is the headline crossing the terminal that the U.S. is providing up to $12 billion to retrofit auto plants for EVs. You got General Motors, Ford, they're extending their gains. It's really interesting how that might play into the UAW worker strike, because, or potential strike, I should say. If you work on an EV, you need less people to do that. It's less labor intensive. And that sort of is a point of, many points of conflict, but it is erupting as a point of conflict between auto workers and automakers. And now you're looking at the government potentially providing a lot of money to retrofit some auto plants for EVs. We're going to continue to look at those headlines, and we will give you any updates as they come. All right, coming up, UBS posting its biggest ever quarterly profit after its acquisition of Credit Suisse. We talked about it before. We're going to get into it with the CEO, Sergio Armati, next. This is Bloomberg. UBS on the road to closing about 5.6% higher, just smashing records when it reported its largest ever quarterly profit for a bank following its emergency takeover of Credit Suisse, one of the biggest mergers ever in global finance. So Bloomberg's Francine Lacroix spoke with CEO Sergio Armati about the challenges of integrating the banks.
We are still counting on wealth creation, growth. I mean, if you look at our ambitions, as I mentioned before, we have a dimension of integrating and managing the day-to-day, but also growing our business. And as the economy grows, our clients monetize situations, we want to grow our asset base, our share of wallet with those clients. And again, you know, our focus right now is to regain back as much as possible of those 200 billions Credit Suisse lost in the last few quarters.
So you're basically flying a plane whilst building a new plane. What takes up most of your time?
building at this stage is a lot of talking on integration, and I keep a little bit of focus also on future growth. I need to almost play around, my time, but the vast majority of my time is on integration, on managing the bank. But I can't really forget that this is one step in the evolution of UBS. And as I look forward, we need to prepare UBS also for the future. So this is something that is very good, because Credit Suisse is not really changing our strategy. It's complementing our strategy. It's accelerating our strategy. We're going to manage 5.5 trillion, or we are managing $5.5 trillion of assets, right, across private and institutional clients. So this is huge, and allow us to really think about how can we now go to the next level. So now we are very focused on integration, on executing our current plans, but we can't forget that the competition and the market is evolving, and we need to stay very focused.
Huge is maybe an understatement there from UBS CEO Sergio Armati, with a record profit coming in. He's speaking with Bloomberg's Francine Lacqua there. All right, just a few minutes to go until European markets close. I want to get you some of your last calls, and this one was interesting. It's Heineken. RBC has upgraded Heineken less than 12 hours after it first cut it. Now, the analyst there said that it was brought to his attention that some of the metrics he had used on Heineken spending on things like ads were incorrect. Now, this is something pretty rare that happens with the sell side. I brought my notes with me because I like this quote from him. The Bloomberg News team interviewed him asking about this, asking about optics. He said, "I'm not sure optics are the main issue. I think honesty is non-negotiable in my job. Once I realized the downgrade was based on an incorrect premise, there was no choice." So you get the quick turnaround for that share upgrade. Not seeing any real reaction, though, in the share price. All right, CMC, this is, of course, the market trading company. Jefferies has cut this, saying that they've just had profit warning after profit warning. We are in this environment where CMC profit has started to normalize. We're kind of away from that work from home trading boom thing that happened during COVID. Those shares falling 6 1/3%. Finally, I want to show you some of the 52-week highs of the day. It will come as no surprise to you that UBS is on the list. Those shares rally 5.6%. We also have Rolls-Royce and Kingspan. Both of them had earnings recently and had some analyst upgrades following them, so the rallies continue. Finally, into tech, this is the Zara parent company. That also hitting a 52-week high. Their earnings come later in the month. All right, the close is up next. This is Bloomberg. Stocks finishing up the day in European trading. Some macro data and end-of-month weirdsies, I think, is a good way to characterize what the map looks like today. DAX, for example, up 0.5%. Sure, that's great, but the CAC 40 is down 0.4%, similar to UK stocks, similar to the IBEX. FTSE Mid, that's down about 0.1%. One interesting story there, the Italian government is reportedly looking at selling some of the stakes of the company it owns to try to shore up the government balance sheet. We are going to be at the Ambrosetti Forum this week, tomorrow to be specific. Maloney has decided to skip that. Some local papers reporting that she is nervous about facing investors. Again, that is not reporting that Bloomberg has matched, but one to keep an eye on. All right, for the overall intraday session, we basically really ran out of steam at the end of the session. We opened higher. We were higher for most of the day, but you can really see it was just in the last hour or so that we get this drop. Of course, the end of the day typically has more data around it. Perhaps traders who are rebalancing their portfolios, waiting to the end of the day to take some profits to sell. One stock that did not see much profit taking because of a record profit was UBS. We had their earnings, the first combined earnings with UBS and Credit Suisse. Inflows were also solid too. They had this negative goodwill impairment, a confusing balance sheet item, but basically saying the euro price tag, Swiss franc price tag that we bought for Credit Suisse, it's actually worth a whole heck of a lot more. So their earnings looked good off the back of that, up 6%. Glencore falling 4%. This is an FT story of lots of different shareholders of Glencore taking a case to the London High Court, saying that in its prospectus that they lied about their trading division, and the lies there were to cover up corruption. So shares dropping on that. Pernod Ricard, those shares dropping some 6 1/3%, reporting earnings that saw a very weak U.S. segment. Now, I spoke to the CEO earlier who said, no, the U.S. consumer is resilient. This is more about normalization. The market not really interpreting it that way, concerned there about whether or not people will still pay up for expensive alcohols. Okay, a quick look at the day ahead, what's going to be coming up in the next 24 hours. I mentioned this, the Ambrosetti Forum. UK train strikes. Also, look for more disruption delays, not just trains. There's been some airport issues, as it seems there always are here in the UK. We're also going to get more CPI data. We've had a lot of it, but we're going to get Switzerland CPI coming in. And Alex, this one's going to be interesting because there's been a lot of concern about growth in Europe. We know the sector is weak. We're going to be getting European manufacturing PMI data.
Yeah, and it's the final read for some of them, like France and Germany, but it could definitely shed light on the growth picture, particularly after Isabel Schnabel's statements from today. So let's get more insight. We're joined now by Ulrich Löschmann, head of FX research at Commerce Bank. He joins us now. What are you going to be watching for? What do you expect from the final read of PMIs for tomorrow?
Well, this is a very crucial point because, as you said, there's more and more signs of a weak European economy. And for me, the interesting part for an FX analyst is it so weak that the ECB will have to react on it, that it will have to stop hiking rates early, or a little bit further down the road, perhaps early next year, we'll have already to cut interest rates. This is a crucial point, and we already saw with comments from Mrs. Schnabel from the ECB Council that the ECB is watching very closely what the real economy is doing here in Europe, and therefore this is highly relevant for the outlook of ECB interest rate policy.
Ulrich, that's really fascinating you say that because it seems like a market that is fully behind that. I mean, we priced out rate cuts pretty quickly today after those Schnabel comments, after the data. The euro, it's weaker versus the dollar. We're just above 108. Is that a trade you would happily follow, or are you a little bit more torn maybe on this coming rate decision in September?
Well, frankly, I don't think that the ECB will hike in September. They will at least make a pause, like the Fed is doing, and it seems to be easy for them because they can follow the Fed in this respect. But the most crucial part is, down the road, will they have any opportunity to hike again later in autumn, or will it be the end of the interest rate hikes that we already have at the moment?
So that leads us nicely, Ulrich, to the question the day that we had, which is, have central banks done enough? And particularly the ECB, that's a tough question to answer. What do you think?
Well, the point is, for the Fed, it's quite easy. If inflation is falling and the economy is doing well, this is an easy job. And they can stop hiking and everything is fine, dollar won't be hurt, etc. For the ECB, it's more tricky. We don't see that inflation is coming down sufficiently yet. It's much quicker, the disinflation in the US than here in Europe. And at the same time, we are getting a weak economy. Therefore, this is a tough point for a central bank. Having weak economy and high inflation is something where it's decisive how they tick. For the Fed, it's an easy job. Every central banker can make it right there. Here, it's very difficult. And the FX market is concerned that the ECB will look too much on the real economic side, on the growth side, and therefore will have high inflation with weak growth, perfect recipe for a weak currency.
So in Europe then, Ulrich, is this the time to start putting to work the stagflation playbook? And if so, what would that look like?
Well, at least the risk is higher at the moment. I'm still in the more optimistic camp where I'm thinking, yes, we saw a lot of bad news, but this is perhaps something which can get better over time. Therefore, I'm still optimistic. But data like tomorrow's PMIs are therefore very crucial for me, because I have to ask every time, can I keep my optimism, or do I have to change into this more bearish stagflation camp? I'm still not in there. But obviously, those data like tomorrow's PMIs can always kick me into this camp. And this is a crucial point, I think.
Well, what I'm trying to understand is why the euro isn't at like 105? Why?
Well, because look, we are at a position where a lot of Fed rate cuts for 2024 are already priced in. And at the same time, we are not seeing so much of rate cuts being priced in by the ECB. The ECB has been the more cautious central bank. And especially all this more aggressive stance of the Fed was very US dollar positive while the Fed was hiking. Now we are near the end of the interest rate hiking cycle. If we are completely at the end, does not matter so much in this respect. We are near the end, and therefore this argument of the Fed being more aggressive is something which is no longer dollar positive. If really in 2024 both central banks would cut, then I think the Fed, with its more aggressive style, has a good chance of cutting even more. And therefore we are in a position where this future outlook is something which is not so much dollar positive like it was in the last 1.5 years.
Oh man, we in the past 1.5 years, Ulrich, it was a place where like the only thing we could cling on to, the only thing we knew would go up was the dollar. I guess we need to rethink things a little bit in 2024. Ulrich, thank you so much for joining us. I'm afraid that's all we have time for. Ulrich Luchmann there at Commerce Bank. All right, now let's check in where European stocks have settled as we head to the break. Again, some divergences here between which index you are looking at. FTSE 100 down about 0.5%. Interesting there because the macro story has been pricing out the steepest of rate hikes after Hugh Pill of the BOE said that they want more of a table mountain. In other words, they don't want to escalate rate hikes rapidly and then drop, be more flat. Even so, stocks sold off. DAX, that gains up 1/3%, and CAC 40 down 0.6%. Now, coming up, we're going to take a technical look at the markets following August's stock slump. We're going to be speaking with John Kolovos, Macro Risk Advisors Chief Technical Strategist, will be joining us next. This is Bloomberg. It's been a tough month. Basically, everywhere you look in this equity market, be it tech, be it the S&P, be it in Europe, major indexes are finishing the month in the red. But our next guest says the S&P is poised to test an all-time high. That is John Kolovos, Macro Risk Advisors Chief Technical Strategist. John, I love to hear it. That makes me happy. But tell me about the setup. When we've had this type of decline, what does it mean for September, which I'm told is seasonally a difficult month?
Yeah, that's true. And thanks for having me on. Yeah, September's got a really, really bad reputation. And the way that I'm looking at things is that from a pure chart perspective, right? We put the seasonals aside for a second. Given trend and recent improvement in momentum, I think we can start tracking the S&P to test that 4,800 level, which is near the all-time highs.
So that would be definitely different than I feel like the vibe has been. And I'm just wondering, in that environment, what happens to the dollar? Like the dollar uptrend has been relatively significant, but we've given up a little bit of that steam. What do the charts tell you about that?
So, yeah, so with the dollar, I think you got to put in perspective, right? The dollar peaked last September, right? And that was when the equity markets bottomed. That downtrend is still in place so long as the dollar remains, the DXY remains underneath that 105, 106 area. And I think that's going to hold, right? That's what the charts are suggesting to me. And when you look at the momentum indicator, it's starting to roll over. That's the MACD indicator that I brought there. That's starting to go down a bit. But also when you look at different other currencies like the yen, that's starting to stall a bit. I think once the dollar breaks underneath 103, then we can really start leaning into the more optimistic equity view.
I mean, there does feel like a lot of markets at this moment. Maybe it's sort of confusion of data. Maybe it's a summer that feel like they're stuck in a range. The 10-year yield feels like that, too. John, I got to be honest, I was off the prior 2 weeks. I came back. It was like that pickup towards 4.5% never happened. Where do we stand?
Yeah, so where we stand is this. It really does look like a false breakout at this point. And that's important. Why? Because a sustained breakout above last October's high, call it around 433, what that projects to about 5.5%. That's quite a bit of a move. And the way the chart looks to me right now, again, with momentum starting to roll over and gain downside momentum for yield, or bonds are getting a nice little boost here, Once 409 is sustained to the downside, I think bonds are going to rally to about 375, which is about the low where they were in July. So you take rates rolling over, you take the dollar rolling over. That really does paint a decent picture for the S&P to get to 4,800 by the end of the year.
Draw the line then to the credit market for that, John.
Yes, the credit market is huge, right? So that has stabilized quite a bit here recently. And again, what's important with credit is it helps you build portfolios, right? So credit conditions were to continue to roll over and improve, that means you can become less risk averse. It means you can start leaning more towards higher beta, smaller cap stocks, the ARChy names, the tech names. You can start doing that. That also means, and this is bad, and maybe some technicians get mad at me, which is this: buy bad charts. It's okay, right? If you think the market's going to move higher, buy those that are oversold. That's not to say I don't like energy. I think energy is going to do well. I think oil breaks right through 100 pretty easily. But outside of that, I think it's okay to sprinkle your portfolio with a little bit more as we get through this summer pullback, if you will.
Just one quick question, John.
Yeah.
How volatile are the charts telling you that this could be? Like once you break out, for example, to the up or the downside, is it just going to stay there, or is the volatility going to really be in place for the fall?
It's going to be in place for the fall, really. Again, you go back to the seasonals. September is the weakest month of the year, and while October is positive, it has the highest standard deviation, right? So I think it's going to be very noisy, a lot of stair-step function going on. We got Congress coming back. I'm sure they're going to create extra noise. Still a lot of geopolitical stuff going out there. So I do anticipate it to not be a melt up, but to be more of a grind. And then what I kind of foresee into next year, probably make marginal new highs, but I'm not sure we're going to make that much more gains past 4,800. And I think the real volatility is going to pick up as we get closer to the election season.
All right, John, really good to catch up. It's really great to get your perspective as we kind of wrap up this month. That is definitely a head scratcher. John Kolovos, Macro Risk Advisors, Chief Technical Strategist, thank you very much. All right, coming up, back to that breaking news from the top of the hour. Automakers are higher now. You got the government spending about $12 billion to retrofit auto plants for electric vehicles. We're going to talk about what it means for the EV space and the impending UAW strike. This is Bloomberg. Stocks eking out a gain. Again, hard to take too much direction from it. You get jobs tomorrow, you get some mixed data today, and volume still light. Abigail is tracking the moves. Abby?
On the week, though, Alex, it's very clear what direction we're going in for the S&P 500, up 3.4%, the best month since the end of March. So we clearly are seeing a little bit of a turnaround from all the selling that we've seen in August. Earlier, just last week, in fact, the S&P 500 down closer to 4 or 5%, the worst month, heading at that point to the worst month of the year. Now we're looking at just the worst month since February, and you can see the NASDAQ 100 up 5%. Now, here's an interesting divergence, though. The VIX is at a 13.7. We have the NASDAQ 100 VIX, the VIXen at 19. So we still have this roughly 5 to 6 point spread. Kevin Kelly of Kelly ETFs, who correctly predicted the tech weakness that we've seen in August, has been pointing to this spread. He's joining us later today on Options Insight to talk about this. I'm going to be very curious to see whether or not he thinks more volatility is to come, especially given the fact that September is a difficult month. Now, before we do take a look at what September could bring, let's take a look at the wild ride that you all were just talking about with yields. This is a 10-year yield, and starting off the month below 4%, up, down, and then higher. This is a classic topping pattern, a head and shoulders pattern, although I would point out that this uptrend is in perfect shape, at least right now. The pattern, that consolidation, which suggests that investors were a little bit too quick to sell bonds, suggests that that trend could be broken and that we could see yields come in further. As for the month of September, it may suggest the opposite because, of course, as yields go higher, that puts pressure on risk assets. This is the performance for the S&P 500 over the last 30 years on a monthly basis. You can see that February a small decline, June a small decline. Otherwise, we're looking at mainly big gains, but we have a small decline in August, so we're sort of on pace for that. We're actually underperforming where we should be. For September, though, this is the worst decline of the year. I was kind of surprised. I would have thought that would have been October and that big crash month, but it is September. So that historic precedent, Danny, I don't know. It's something to keep in mind, even as we see yields come off those highs.
As our last guest said, September's got a bad rep. Abigail, thanks so much. Bloomberg's Abigail Doolittle. All right, a quick look at some of these auto stocks. For GM, Tesla, all of them are up today, moving after a U.S. DOE announcement that they will be making $12 billion available via loans and grants for automakers to retrofit factories for EVs and hybrids. Joining us now is Bloomberg's Craig Trudell. Craig, what exactly are the details of this? What is the DOE doing here?
Yeah, it's honestly, it came as a little bit of a surprise, and I'm still waiting on a bit more of the sort of nuts and bolts of what exactly, which loan program this is coming out of, how much of this is, already sort of baked into IRA and what is entirely new. Is it all entirely new? But my first reaction to this was, gee, what a coincidence. We're getting down to crunch time for GM, Ford, and Stellantis to negotiate new contracts with the United Auto Workers Union. The sort of tone of those talks have been really intense. All sort of indications of a likelihood of a strike there. And will this help the companies sort of get more comfortable with making some of the investments that the union is going to want to squeeze out of these companies?
Well, I was going to say, does this help free up money for them to give the pay raise at the end of the day?
I think you're going to see some pushback still on the part of the companies. Absolutely. This is helpful to them, in terms of making these investments to retrofit these plants. But, will they be willing to sort of make these plants uneconomical or uncompetitive relative to ununionized plants? I think it's still, a question as to whether or not, they're going to be willing to go that route. These are, fixed costs that will last longer than just these one-time investments of taking a plant that's made combustion cars, made engines, made transmissions. Much as this is extremely helpful to the economics of transitioning their lineups over to electric vehicles, those are costs that they're going to want to still keep contained. And so, how the union and the companies are able to resolve that is still an open question.
Of course, the Biden administration might come back and say, look, this is just all part of our effort to get all sales be EVs of cars by 2030. Maybe it's not about labor necessarily, but of course they want to project that image. On that front, on that goal, because adding this in with what we've seen from the Inflation Reduction Act, when can we start to see signs that it's actually having an effort? Because I'm guessing we wouldn't see signs yet, since this is all just putting the investments in. And quickly here, Craig.
Yeah, I think it absolutely is going to be a case of this playing out over years, right? It takes these companies several years to stand up new plants. It will take them quite a long time to change these over. Many of these factories have been around for decades, and so it's not a simple matter of changing things over. A lot of equipment will have to be ripped out, put in, and this will cost a lot of money. So this will absolutely be helpful toward that.
All right, Craig. Hey, thanks a lot. Really appreciate it. Craig Trudell joining us. Really interested to see where that money is going to come from, Department of Loans, etc. All right, here's a story that we're watching. Kylie Jenner is said to be looking to buy back the majority stake in her cosmetics brand, Kylie Cosmetics. Now, reclaiming the lip kits that made her a billionaire. The reality star turned influencer and entrepreneur sold a 51% stake to beauty company Coty for $600 million back in 2020. Jenner's previously expressed frustration with how the cosmetics company managed the brand, but so far neither side has commented on whether a buyback is on the cards. I do have to say, as much as I hate it, a lot of what you see on my face is Kylie Jenner. It's good eyeshadows, man. They have really nice highlighters.
It looks fantastic, Alex. Also, to that, I would also say, what would Guy have said? Are you kind of sad that he's not here for this conversation?
Totally sad, actually. And we could definitely talk the finer points of highlighting versus contouring. I feel like that would have been a little fun.
Guy definitely uses Kylighter. There's no question about it. Okay, a different story we're also watching. This one was really interesting. It's one for the record books. A Nebraska volleyball tournament set a world attendance record for a women's sports event. The game drew more than 92,000 fans to the Memorial Stadium in Lincoln. The previous record for attendance at a women's sport event in the U.S. was the World Cup final in Pasadena, California, 24 years ago. Alex, this number is even more than the men's World Cup. They had, I think it was about 88,000 attendees, just to give you an idea of how massive this event was.
I feel like there's a theme here. Record attendance at a women's volleyball game. Kylie Jenner kind of taking back her brand and her business and buying that back. We have Barbie continuing to crush it, let's just say it. And then Taylor Swift taking her Eras tour to AMC. I feel like there's a thread.
Yep, there's a thread. I think it's pretty obvious too, so, going to leave it there. I feel like I don't need to say it. All right, Alex, I want to get through some of what we are watching in the next few hours. Earnings after the bell, we're going to have Broadcom, VMware, Dell Technologies, and Lululemon.
Yeah, let's see about those yoga pants. All right, thanks, Danny. That wraps it up for us. Coming up, Bitwise CIO joins Bloomberg Tech. This is Bloomberg.